When someone asks what your car costs, you say the payment. Everyone does. It's the number on the paperwork. It's the number the dealer talked about. And it's the number you compared against your budget before you signed. It is also, reliably, the smallest number in the whole arrangement. There are 6 more costs sitting underneath it, and together they usually run larger than the payment itself. In the next few minutes, I am going to add up all 6. I will show you the 7th cost that never appears on any statement, and I will give you 3 rules that stop a car from quietly eating your future. At the end, you will know the real number. Start with why this happens, because it isn't an accident. At some point, the entire industry stopped selling cars and started selling monthly payments. Ask what something costs, and the answer comes back as a payment per month. It's a brilliant piece of design because a payment is small, familiar, and easy to say yes to, while the actual price of the thing quietly slides out of view. And there's a second effect that's even more expensive. When you shop by payment, the obvious way to afford more car is to stretch the term. Same payment, more years. It feels like a discount, is it? You pay for longer, you pay more interest, and you spend more of the loan owing more than the car is worth. The car gets bigger, the payment stays comfortable, and the cost quietly grows. If this is already making you do math in your head, you are in the right place. Don't forget to subscribe and give a thumbs up. It genuinely helps this channel reach the people who need it. So let's do the thing the industry never does. Let's add everything up. Cost 1. Depreciation. And this is the big one. A new car loses a meaningful share of its value in the first few years simply from being owned. You don't feel it, because nobody sends you a bill for it, but it's real money leaving your net worth every single month. And for most new cars, it is the largest cost of ownership by a wide margin, usually larger than fuel, insurance, and repairs put together. Cost 2. Interest. If you borrowed, part of every payment isn't buying the car at all. It's rent on the money. On a long term, that rent can add up to a serious amount on top of the price, and it's paid on an item that is losing value the entire time. Borrowing at interest to own something that is shrinking. That is why car debt behaves so differently from a mortgage. Cost 3. Insurance. And note that it scales with the car. A more expensive vehicle is more expensive to insure, so the upgrade you made once keeps charging you every month, quietly, for as long as you own it. Cost 4. Fuel or charging. This is the one cost people do track, though usually by feel rather than by number. It is worth actually measuring, because it is driven by your commute and your vehicle's efficiency. 2 things that are easy to underestimate when you are standing on a forecourt imagining weekend trips. Cost 5. Maintenance and repairs. Tires, servicing, brakes, and the thing that fails the week after the warranty ends. These arrive irregularly, which is exactly why they feel like emergencies instead of what they actually are. A predictable annual cost that simply hasn't been divided into months yet. Cost 6. Everything the car makes you pay just to keep it. Registration, taxes, inspections, parking, tolls, the occasional fine. Individually small. Collectively, a permanent monthly subscription you never signed up for and never see listed anywhere. Put those 6 together and you get the number that actually matters. Not the payment, but the true monthly cost of moving yourself around. For most people, that figure lands somewhere close to double the payment they quote, which means the honest question was never, can I afford the payment? It was always, can I afford the payment times about 2 every month for years. There is one more cost, and it doesn't appear on any statement anywhere. It is what that money would have done if it had gone somewhere that grows. Take the gap between a sensible car and an impressive one. The extra few hundred a month you would spend to move up that gap, invested consistently instead over a couple of decades, has historically had the potential to grow into a genuinely life-changing sum. These figures are illustrative, not a prediction, and all investing carries risk, but the shape of it's not in dispute. A few $100s a month over 20 or 30 years is not a small decision. It is one of the largest financial decisions most people make, and they make it while sitting in a chair, being asked what color they would like. This is not an argument for having no car. For most people, a reliable vehicle isn't a luxury. It is how you get to the job that funds everything else. The point is narrower and more useful than cars are bad. It is this. The difference between adequate and impressive is usually paid for out of your future, and almost nobody is shown that trade before they sign. So here is how to buy one without losing the decade. 3 rules. Rule 1. Buy the total, not the payment. Before you look at anything, add all 7 costs for the specific car you are considering. Depreciation, interest, insurance, fuel, maintenance, keep it costs, and what the money could have grown into. Then decide. Every single tactic used on a buyer stops working the moment you are shopping by total costs. Rule 2. Cap transport as a share of your take-home pay. A modest, single-digit to low teens percentage of what actually lands in your account. All in, not just the payment. A cap makes the decision once, calmly, at home, instead of 30 times in a showroom being told what you deserve. Rule 3. Let the depreciation curve work for you, not on you. The steepest loss in a car's life happens in its earliest years. Buying a well-maintained vehicle a few years in means someone else already absorbed that drop for you, and buying something reliable and keeping it long after it is paid off is unglamorously one of the most effective wealth-building moves available to an ordinary earner. And when it is finally paid off, keep making the payment. To yourself, straight into savings or investing automatically on the same day of the month it always left. You have already proven you can live without that money. Now it can go somewhere that grows instead of somewhere that rusts. Duh! The 6 costs under the payment. Depreciation, the biggest and quietest of them all. Interest paid on something that is shrinking. Insurance that scales with your choice. Fuel. Maintenance that is predictable but unscheduled. And the permanent keep it subscription. Together they typically run close to double the payment you would quote. Before you count the 7th cost, what the money would have grown into. Nobody is asking you to give up your car. The ask is much smaller. Know the real number before you sign, not 2 years after. Because the difference between a car that moves you and a car that impresses people is rarely just a few $100s a month. Over a working life, it is often the difference between arriving at retirement comfortable and arriving there wondering where it all went. This is education, not financial advice. The examples here are illustrative and simplified. All investing carries risk, including possible loss of principal. Everyone's situation is different, so please talk to a licensed professional about your own. If this changed the number in your head, do me one favor. Don't forget to subscribe and give a thumbs up. Every week we break down how money really works, with no hype. And now the question I actually want answered. Add it up honestly. Payment, fuel, insurance, repairs. What is your real monthly car number? Drop it in the comments, no judgment. I read everyone. I'll see you in the next one.